In an overvalued bond market, where do you put your money? I'm Jack Otter, editor of BARRON'S.com. I'm here with Mike Aneiro, who writes our income investing column. So, Mike, you and I have talked a lot about how everything in bond land kind of looks expensive. Yields are low, which means prices are high. One area that looked attractive was muni bonds. We talked a lot about how, thanks to concern over Puerto Rico and Detroit, municipal bond prices were artificially low. Well, now they've risen, so that doesn't look like a good place anymore.
It's exactly what happened was that munis got oversold last year. Then people realized, hey, this asset class looks oversold, and they bought them. And now the problem is they might look a little bit rich because they've had a very good run-up during the beginning of this year. And this creates a conundrum that a lot of people are becoming aware of in the bond market, reinvestment risk. If you were to do what is usually prudent, which is when something rises in price beyond what looks like fair value, you say, hey, maybe I should sell a little of this, take some profits, and invest it in something else. And the problem with bonds is, where are you going to put it now? A lot of bond asset classes, almost across the board, look overvalued. So it's a question of, if I were to book these gains, where do I put this money? And that really creates a question when you're trying to decide whether or not to sell.
So in this week's Barron's cover story, the roundtable, or the mid-year roundtable, I should say, Bill Gross has a couple of ideas for where to put that money. Gross, of course, was well known for his running the Pimco flagship fund, the total bond market fund, total return fund. But he has some smaller ideas, and what's interesting here is you say some of them are actually only really available to individual investors.
Right, closed-end funds in particular. When you talk to a lot of big mutual fund managers, they often lament that they can't really invest in closed-end funds to the extent that they would like to, because with closed-end funds you get gaps in valuation in terms of the net asset value, whether the value of the holdings is the same as the price of the closed-end fund. The problem with big money managers is that if you buy a huge amount of closed-end funds, you're going to move the price of the whole asset class. But individually, if you talk to managers, when they're buying for themselves, as Bill Gross mentioned in our roundtable, they like to buy these as investments on their own.
So what are some names?
Some of the names that Gross liked were, one interestingly is a Blackrock fund, which is a rival of Pimco's obviously, but it's the Blackrock Build America Trust Fund. Ticker is BBN, and it has about a 7.5% yield, and it trades at about an 8% discount to net asset value. And that, if you recall, the Build America Bonds program lasted about 2 years, 2009, 2010, and it's a taxable municipal bond program that receives federal subsidies. So you're basically buying a taxable version of the muni market.
They were quite hot. A lot of people really were crazy about those when the deal first came out, and then of course they got overvalued like so many other things, but this is a chance to get them at a discount.
Right, again through the closed-end fund structure you can get a discount to net asset value.
What else has he got?
He also had the Pimco Dynamic Income Fund, PDI is the ticker, with about a 10% yield. It does not trade at any discount to net asset value, but its investments are non-agency mortgages, which tend to be pretty safe if you like the housing outlook, and given the yield, it's a pretty attractive income producing investment at a time when it's hard to get income. And the other one is an exchange-traded fund, the iShares U.S. Preferred Stock Fund, about a 6.5% yield, ticker is PFF, and that invests in bank preferred shares, which a little outside of bond land, but it's a very good way to get yield.
Now we should say that those preferred shares won't really provide your portfolio with the shock absorber that bonds are supposed to in a big downturn, but still, as you say, it's nice income. The 10% yield on the other fund worries me. I mean, whenever I see 10% yield, a red flag goes up. But do you think there's some safety there, margin?
Well, it depends a little bit on your housing outlook. Non-agency mortgage bonds were some of the scapegoats for the housing crisis and the financial crisis that followed. If you believe that we are in a healing market and that things look a lot better now, some of these securities are still, they've got a bit of a tarnished reputation, but they seem to be significantly better now in terms of quality, in terms of oversight, et cetera. So if you believe in that story, then you should look for that yield.
Thanks very much, Mike.